From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. I'm Mike Maxson. That's Brandon Gray. And we got the OG himself for this episode, Mr. Greg Crabtree.
Yeah,
Greg.
Finally, you guys let me on my own podcast.
You're right.
So, in our defense, this is the first week Greg has been in the office all of them. And so, when you're in Southeast Asia, it's really hard to do the podcast. That's But yeah, we're excited to have Greg on.
They have internet thing.
He's got to check up on us once in a while. So, since you're gracing us with your presence today, what are we talking about?
It's the hot topic, and we've been watching this for years, but probably one of my most asked questions when I do a presentation is people want to talk about the black hole. And obviously, when I wrote the first book, most of the writing occurred in 2009, 2010. That's a long time ago. And so things have moved. Inflation has changed the dollar values of things.
Just
just a little, but I would say, the black hole starts at $1 million of revenue, goes to 5 million. The deepest, darkest moment was at 3 million. And unless you're just a super low gross margin business that's passing through stuff, you'd use gross margin instead of revenue. But that generally was pre-COVID. And, in our continual study of the 100 company model, I feel like we've struck some gold in terms of being able to see some things that are not easily seen by government data. And so one of the things I want to reset, for everybody who's listening, for the most part, government only has access to publicly available data. And so the last numbers that I had showed that, private business makes up 65 to 70% of the US GDP. And so how accurate can the government data be if they have no insight on 65 to 75% of the economy? And so that's really why I felt, our 100 company model has been golden in terms of giving us this basket of $1.3 billion of revenue of all geographies and all different industries. And it's been a pretty good basket of goods and services that I feel like that's given us a unique insight, into the marketplace. And so we continually look at slicing. And so I think, probably, the audience have heard you guys talk about in previous months, the over 10 million size companies and the under 10 million. And that's an interesting split. And we've definitely seen the under 10 million, size companies struggle financially compared to the over 10 million. So that really, and that really has been a significant data point that really led us to get Brantley King, our consulting staff member that pulls the model together. He did a quartile model of looking at, of the 100 companies, 25 companies in each section. It was a really fascinating picture of what came out. And so I'm going to talk through those, in just a second. And for people watching this on YouTube, they'll see the graph and the picture that I'm going to show, but I'll talk through it so that if people are just listening, they'll know what I'm talking about. But in essence, looking at that data, it has appeared that I can say that the black hole has moved, that I believe the beginning of the black hole is closer to 3 million now. So over the years, as I've worked with companies in the Entrepreneurs Organization and other business groups, I did start to see more and more businesses get into the 2 million, 2.5 million, almost to 3 million range, and still be relatively thin in terms of management labor, the owner, doing most everything. And so, I'd started seeing that begin. But what I didn't expect is, yes, I believe the beginning of the black hole starts at 3 million, but I think it goes to 10 million now in terms of impact. And that is kind of stunning. But as we've looked at, our clients that we talk to every month, the various reasons why, number one, I mean, the key impact that continues to be is, when you enter the black hole, you've got to invest money in management labor that you can't afford. And so you're going to hear about that in terms of the labor ratios, as well as the impact on your cost structure. But the one thing that I'm going to have to, it is, I think this may be the first time that I've had to retract something that I'm on record for saying multiple times. Because I've said it from the stage, I've said it from recordings and podcasts. Don't worry about non-labor operating expenses. Just get gross margin to revenue correct, and the business will be fine. The rest is just the noise of business. I'm here to tell you that in the last 3 years, that's become words that I've got to eat, because non-labor operating expenses have become a problem. And it's also become a basket of goods and services that we now track uniquely that I think is the clearest picture of inflation, because it's goods and services. One of the weaknesses of government data, they look at CPI, Consumer Price Index, they look at PPI, Producer Price Index, and a few other things. But the problem is, our economy is a blend of purchasing of goods and services. And you've got a distinctly different issue of consumers, because we're also seeing the business to consumer marketplace. The bottom 60% of the wage earners are really, really, really struggling to make ends meet every month. And so our clients who sell to that bottom 60% are seeing massive schizo swings in demand, where, those customers are switching. This month they'll buy that product. Next month they won't. Next month they'll buy that product. Next 2 months they won't. And you're seeing this inconsistent schizophrenic demand cycle in any time that you're relying on that bottom 60% of the wage earner market. Conversely, if you're focused on the top 40%, more apparently the top 20%, if you've got a compelling good or service to that marketplace, they got money, they're able to buy. There's a little bit of survivor guilt going on, in the high end, but not much. They're still spending. And most of our clients that, deal with that high end consumer marketplace, they're fine. I mean, they're growing, and especially, and realistically, their only challenge is execution to deliver on the higher demands of that high end consumer, and meet their time schedules and their quality schedules, in those things, in that process. And so it's really kind of interesting of, when you're looking at the economy right now, because our data, from the way I'm parsing it, appears that we're like negative 1% GDP if I'm going to make a call. And yes, I'm going to give everybody slack that tries to predict GDP, because it's a hard number to predict for various reasons. But I really do think we're about minus 1%. And you've entered into the economy of the vast majority of goods and services are just hand-to-hand combat to fight for market share. And I just want to elevate that I've got the attention, of our Simple Numbers community. Market share gains is a dramatically different sales and marketing strategy than riding the wave of market growth. And if you really don't retool and rethink your marketing and sales activities, for this market share part of the economy, you're not going to have success, and you might end up going backwards more than going forwards, in that process. So, and so Mike and Brandon, you guys, of the clients you see, any inconsistencies from what I've just said?
No, I think I explained it to my client the other day is these companies coming up around that 3 million mark that you mentioned at the start of the black hole. Once upon a time, you begin to settle in a little bit, and I'm not saying hit full scale. Begin to put. You got to push through that initial OpEx investment. You get to 5 million, you start getting a little bit of scale, but now it just seems like they were just beginning to take a lot longer to push through that OpEx investment to scale. The costs were rising too fast. They couldn't bring enough margin in at the same pace. And that's where you saw it stall weirdly around 6 million, around 7 million, where you're like, wow, you should be way past this by now. But it's taken longer to come out of it. And I didn't say it initially as so eloquently as you, but you saw it, weirdly around companies that size were prior to this when, you had written about it for years. Yeah, 5 million, man, you started seeing that relief right there, cash wise, everything. And not seeing it.
Yeah. And, and I think if the clients that I've dug in deep on, the components in the non-labor OpEx is one of the biggest culprits, is the one that's getting a lot of accolades right now. And you got to be careful. And it's technology spend. We've had clients that just, when we see, mostly the platform technology goes into the facilities line on our simple numbers model. And when I start seeing a facilities line go up, we dig in on the call and look at, okay, well, did you change facilities? Did your rent go up? And a lot of times they're buying technology tools that sounds great. And it's like, oh, it's going to help us do this. And this is going to help us do this. And when you see tech spend go up and contribution margin doesn't go up commensurate, you got to go back and look at it and say, well, that sounded good, but did that really allow me to do something different? And on the other side, there's a lot of tech companies that are raising prices now because they're under a mandate from their investors to get profitable. And if they don't get profitable, they're going to go out. Just this morning, I was looking for an AI, tool that I was going to play with, and I had done a search, for this particular capability, and Google. I think I used ChatGPT, and so it gave me a list of like 4 AI agent tools. Well, the first one that was the most highly recommended, they're no longer available. So they're sounding cool, that what they were going to be able to do, and they've already exited the marketplace. And so the business models of those things are changing rapidly, but they're under the same mandate. All businesses will be required to be profitable at some point, sometime,
So
and you can't get away with it.
So Greg, what's the or Brandon, to either one of you, what's the play here? Like we've talked about it, we've written about it, companies try to expect relief. Let's say you venture now into the black hole, same plays as before, or are you looking at something different? Because you mentioned the market share growth versus market growth. Are the plays still the same to get through it?
I think we got to bring back Scrappy. Here's the thing. Just the behavioral psychology of business over the last 15 years is invest and grow and grow, invest and grow. And, you can't be behind. You can get by with a lot of stuff that you don't have. And I think we've lost a bit of that scrappiness, that new businesses and, it just get by. And yes, I get it. We want to use AI tools. We want to use technology, very smartly, and certain, a lot of entry-level businesses now have to invest in point-of-sale systems or field management systems just to be competitive. But there's always things that you can look at those and say, do we actually really need to have that? And does that really actually give us a competitive advantage? Or are you just wanting to spend money that, sounds good and you can make a case for it, but the numbers doesn't play out in the long run, and you can do business without that cost.
Right. I would
Yeah,
say
a lot more expense control.
the principles of going through the black hole, from back in 2010, 2011, they're still the same. You got to get profitable with what you have. You got to run really fast, and you got to carry a stack full of money. Now, and how you execute on that, that's definitely changed, because during that prior time frame, the marketplace is growing. And so I was a benefactor of the market growing. And so I didn't have to be great with BD. I didn't have to be great with marketing. Inflation was low. The cost of everything, as Greg mentioned, from apps and technology to marketing, it was all low. So I had plenty of room for error. In the current marketplace, all those have changed. And so I got to have a strategy to go steal market share. Well, how do I steal market share? If you don't know who your ideal customer is, and if your team can't communicate your competitive advantage to go steal business, and you're going to try to go into this black hole, good luck, because no one's coming to save you. There's no market uptick going to happen that's going to bail you out. And it's kind of like we said last year on the podcast, year before, there's a difference between deal makers and deal takers, and the market's flooded with deal takers. And so if you don't have a team of deal makers, you got to be real careful. And as you look at, and Greg's gonna go through this quartile data, as you look at those businesses above 10 million, just compare them to the ones below, and you go, well, what do they do different? Well, they can steal market share. We just covered that. Secondly, they understand the difference of what scalability means versus just increases in cost and activity. So if you're a $5 million business and you send 2 people to a conference, and I'm a 10 million and I send two, we spend the same amount, but it was twice as expensive for you. And that part, trying to get through that and plan, is what's hanging people up. They're just expecting it to come to them, and you can't.
Well, and one of the recent, I just had a call this morning, with a client in construction space that does a lot of bid construction. And, the last 2 contracts that they lost, they put in aggressive bids, but responsible bids. And they lost to 2 contractors that not only didn't bid any profit in the job, they didn't bid full overhead. And because they see the bid data, they made errors in the direct cost that's required. And so, there's some industries right now that, and I told them, I said, you may have worst case scenario, I think is the worst case, but you got to be prepared for this. You might have to defend your status in the marketplace and be at no profit to wait out the idiots of the market that don't know their pricing. And it may be 12 at a bad competition, but this is the good side. Everybody calls me Mr. Sunshine lately based on, no growth prediction. But I think here's the sunshine. If you're the top competitor in your marketplace, you want this. We're going to clear out 20 to 30% of the bad competitors in almost every industry and reset the playing field, that the good competitors are now going to see their separation for the first time, because the good competitors weren't getting any separation from the bad competitors when the market was exploding in growth. You just had to be available. Now we're seeing those good competitors of our clients that are solid in the market, and it's not bid work. The bid industries have their own unique challenges, but if it's not bid work, they're solid, they're making profit, they're going, hey, what's the problem? We're doing fine. It's that, because the new customers are coming to you from the bad providers that are struggling and failing, at execution. And it goes back to, as we said, the theme for 26, for Simple Numbers community is optimization. This is the year of optimization and execution. And if you are the flawless, optimized company and can execute, you're going to be fine. Everybody else is going to be heading for the exit door of one way or another. And just be careful if one of those people exiting knocks on your door and say, please buy me. Just understand that buying is not all it's cracked up to be unless you get it at the right price. Because as we always like to say, there's a few skunks in the woodpile sometimes, and you got to get the out before you make the purchase. Look at it's quartiles, and so so for the people that'll watch this, you'll be able to see it. But I'll talk it through if you're only on audio. So we've taken the 100 company model, 1.3 billion of revenue, and we've broken it down 25 companies in each quartile. The largest quartile, the average revenue is 34 million. The second quartile, the average revenue is 11 million. Third quartile, the average revenue is 5 million. And the fourth quartile, the average revenue is 2.4 million. The first indication is, I've just got back from a Southeast Asia speaking tour that I did talks in Malaysia, Indonesia, and the Philippines. And I can tell you, we have discovered, we didn't create this, we discovered it. This has been hiding in plain sight since the beginning of time. We believe that profitability is universal globally. Capital is not. Capital requirements are vary by trade terms in regions and countries, for various reasons. But profitability is I get to see data from companies around the world through my EO and Horton program, and also my international speaking. But the profitability that's universal for every company in every industry is profit to gross margin. Once we understood that you take revenue minus the non-labor cost of goods sold, keep labor out of it, your materials and subcontractors, that gross margin number is the true economic top line of the business. And when you measure profitability to that number, our profitability standard today is minimum 15% profit to gross margin. That's your no-fly zone. Don't go below 15. 20% is your target. 25% is your stretch. What we see is working up from the bottom, the $2.4 million bottom quartile, they're at 13% profit to gross margin. So when we pick our companies to go in our 100 company model, we don't pick the winners and losers. We just take companies that are a blend of industries, a blend of geographies across the U.S., and put them in the model and live with whatever is in there. And so as a group, that doesn't surprise me that they're slightly below the 15% profit to gross margin minimum. Their OpEx, excluding management labor. So everything in your OpEx, facilities, marketing, payroll taxes and benefits, and other OpEx is 49%. Now, the next number is going to make that number relevant. Is when you move up to the next quartile, you see at 5 million average revenue, your net operating income to gross margin goes down to 9% from 14. So you lose 4% profit to gross margin. Why? Is because your OpEx to contribution margin goes up from 49% to 56%. And so this is a cost that didn't exist pre-COVID. You would actually get a little better. But right now, for some reason, and we think it's more in tech spend and maybe a few other handful of expenses, but the tech spend has probably been the only common denominator, that I've looked at, so far, is you're just picking up platform costs that you've got to spend money on to be legitimate, to operate at that second level. Then when you move up to the 11 million pace and get past 10 million, that OpEx to contribution margin goes from 56 back down to 48. So now you're getting some gains, and then at 11 million average revenue, you're at 14% profit to gross margin. You don't get the 15% profit to gross margin until the top quartile of 34 million. They're at 16% profit to gross margin, and their OpEx drops to 44. And so that those four you start at 49, go to 56, back down to 48, then down to 44 as you work through, those size comparisons. Now, Also, we see this, this is a really good picture of also what happens to labor leverage. So let's start with total labor efficiency ratio. Your total LER that we talk about, gross margin divided by all labor, management and direct, everybody, that down to the floor sweeper, you're at 1.95. So we talk about, 75, 80% of the businesses in the economy works off of a 2 that gets to their 15 to 20% profit adjusted margin in that number. So that bottom quartile is at $1.95. It drops to $1.91 when you get to the 5 million average size business. It drops to 187 when you get to the second quartile of 11 million average. It drops to 1.76 when you get to the biggest business. What is that telling you? Every stage of market share acquisition exacts a margin price. And when I was talking to the businesses on my Southeast Asia trip, and I did an exercise with them that they shared their data with me, and I would talk to them, and quite a few of them are stuck. I mean, they've not had revenue growth in the last 2 to 3 years, and many of them said, well, I can grow the business, but the next big tranche that I need to grow to, they want me to give them a 10% or 15% or sometimes 20% discount to get to that next tranche of revenue. And here's the challenge with that. How, if you're at your profit target with, say, 30 million of revenue today, can you give a 10 to 15% discount to the next 10 million revenue growth without eroding the profitability of the margin of the first 30 million? And, I don't know about you guys, but I don't see our clients do very well at that, of putting a fence around what you built to then give a discount to the next chunk and maintain the original chunk. So, I mean, any thoughts on that?
Only in very rare circumstances to where it's like a one-off kind of thing. But in most cases, and even like in the service industry, it applies. You get used to a certain level of performance and standard, and then you tell them to do less, they won't. You're not going to deliver less than what you're used to.
Yeah. And say that is the challenge that, and that needs to be a unique strategy. And that I've said earlier, there's a different strategy for market share acquisition that you got to deploy both in sales and marketing effort, but also operational maintenance effort. You almost have to, like you said, put a fence around the original work and almost look at that next thing as a separate division, separate, category, line of business, something along those lines. So next, let's talk about direct LER and management LER. So this is one of the clearest presentations of telling you the opposite effect that happens over time with scale of a business. Direct LER starts at 356 when you're the smallest, and then it goes, you have kind of hit a plateau. You give ground, you're at 312 when you're at the second quartile or the third quartile. You're at 319 when you're at the second quartile, and you drop to 256 when you get to the first quartile. When you're at 34 million, you're at 256 direct LER. You're $1 less LER at 34 million as you were at 2.4 million. How do you make up for that? You're at a 3.09 management LER at 2.4 million. You're not as efficient with management labor when you're small. You get very efficient with management labor. You get the 3.45 at management labor efficiency when you're big. And so those two things go in inverse relationships. As direct LER is declining, you have to get more activity managed by your management labor, or you're growing unprofitably. You will be big, and you will go out of business because you can't manage. You have too much management cost for the actual margin, that you're getting out of the business, in that process. So, anything to add from either one of you on that?
I think it just tells the story of if you follow a business across these quartiles as it was growing very, very well. Like Greg said, we got to get scrappy. So you're typically scrappy when you're 3 million and below. And then, you need a new CRM, and we need a new ops system, and we need a BD manager, and we need a marketing manager. And you move, and you start to feel that, as our data suggests now, around $5 million. It really starts to peak.
Yeah.
And then if you're successful in continuing to gain market share, you grow into those costs at around 11. And then the danger that kind of lies in the bigs. So, Greg pointed out how management labor has to step up and what have you. At the same time, you get so large at times, you start to lose the feel of the smaller things, the small expenses. And so you kind of think they can become a rounding error. So you got to kind of watch it and be cognizant, because you are big enough to actually achieve scale at that point in time.
Yeah.
Greg, what are the cases here? And I agree with everything Brandon said, but what are the cases here regarding the inflationary side of it with wages where, look, no one is, I still haven't found anyone that wants to get paid less. I know it wasn't as pronounced maybe during COVID when people were job hopping and just grabbing big salaries forever. But I mean, man, with the costs out there today, I mean, people are still wanting to make more money, which is totally fine. Have you seen this impact things as well?
Well,
In terms of
yeah,
bringing down the LER?
So I think what we're saying, because I think we can safely say this is the softest labor market that we've seen in 20 years, in the white collar space. There is softness even in the blue collar space, except in, maybe blue collar trades that are specialized and need certification. Those are the toughest to get. But still, there is some availability though too. I think what you're seeing, Mike, is that your good people that are performing for you are able to negotiate good raises, and you need to be continuing to feed them raises. And especially if they're the managers of your tech platform, of the deployment of AI tools and automation, and you're shifting, you're skinnying up your direct labor force, even in your management labor force, and with less people, and the keepers are making 15-20% more because they're the keeper. What you don't see the inflation is when you go out in the marketplace, because it's soft, you're not seeing the exorbitant salaries that the unproven people were commanding during early COVID days. That is softened tremendously. And you've got a couple of marketplaces that, if you're a software developer or you're in the marketing industry, I mean, those two skill sets are just really struggling, because there's a lot of available labor that has been dumped on the market because of automation. And yes, there's still good developers being hired and utilized, but the armies of people that were the working minions, so to speak, that those are the people that are going to be left out in the cold, in that process. All right, well, let's move on. I want to finish up with this one thing of, I think we have found the truest indicator of core inflation that I've seen. And so this was a graph that I was playing with the data, and it just really spoke to me. For those of you listening, we're taking year-over-year growth rates of revenue, gross margin, total labor, non-labor operating expenses, and then net operating income. And if you were able to see the graph, what you would see is, beginning in 20, these are rolling 12 data points, looking at year over year. You can see that the marketplace going into COVID revenue from this group of companies that we were looking at, they were hot. They were coming into COVID at like 22% year-over-year growth rate. And those revenues dropped to about 7% by the end year-over-year growth rate by the end of 2020. Now, what that's telling you is, now, yes, some companies lost revenue, during COVID, but a lot of our clients didn't. They just slowed their growth rate. And then they picked back up that revenue growth rate in 21. And then 21 was the peak of the growth rate during COVID. And then that growth rate has really just slid down to about an average of about 4 to 6%, average year-over-year growth rate, from then. The non-labor operating expenses, this unique little basket of goods and services, normally in the past, and the reason why I said it's noise, don't worry about it, it was what I called a lagging indicator. It would eventually catch up in the long run, but all of us, when we were growing, we actually made extra profit for the time period waiting for that non-labor OpEx, because sometimes it took it a year to catch up in those things. And now, and so during this decline of starting in December of 2019, this yellow line, if you ever watch the video, this yellow line goes to 0 year-over-year growth rate in February of 21. And then it does something unique. It spikes up at a higher growth rate than any other of the line items of the revenues and even cost. And it peaks at a 25%, actually closer to 30% year-over-year growth rate in April of 22. That, I believe, is the pure abject inflation of the marketplace. I mean, we saw it in our clients' data, and not only our clients were increasing, what they were charging, they were being increased by what other people were charging them in that process, and it peaked at there. Now then, it is, and really what I will tell you is, because it was so inflation fueled, that 22% revenue growth rate in 22 was all inflation. It wasn't growth. People weren't doing more. We touch our clients' data every month, and we talk to them. People weren't adding bodies. For everybody that was adding a body, people were losing bodies. So the net gain was 0. And this was all inflation. And so as that inflation started to, it's like a pendulum going back and forth. You surge because everybody's behind. And people never raise prices soon enough. They're always behind. And so this was the catch-up response, raising prices in 21 into early 22. And then that price increase, stayed, and it's really kind of settled out to about 8%. Here's the thing. People aren't doing more. So when you're not doing more, that yellow line of other OpEx, non-labor OpEx, should go to 0. But it's not. It's staying at 8%. And it's been there since late 23. And because the non-labor operating expenses should operate off of activity, not dollars. But I think that is the clearest sign of a basket of goods. And here's the unique thing. Growth in profitability is inversely relational to the growth in non-labor OpEx. Mm-hmm. So we see the highest spike in year-over-year net income is when non-labor OpEx hit the 0 point in February 21. So year-over-year income almost was a 98% year-over-year growth rate in terms of dollars. When non-labor OpEx reached its peak in April of 22, profit was negative 18% growth rate year-over-year for those months. And then it spiked back up when, people started tweaking their prices. And so you've got, our clients adjust their prices relative to their cost where they can, and the necessary businesses can continue to push their prices up because they're necessary. Market's going to pay whatever their cost is. But the discretionary clients that we have, they're getting their head handed to them. And I'm worried that a lot of them are struggling for sustainability and survival, in that process.
It's been a while since Greg's been on. There might be some folks listening that aren't super familiar with Greg. I think you guys picked up, he's pretty sharp. He knows what he's talking about. And guess where Greg's going to be in November, Mike?
At the Simple Numbers Conference.
Really? I'm invited. He is. Hey, Greg, you're a keynote. You really got to be there.
I will tell you, now, I talked a lot about economics today. Just remember, I'm just a chicken farmer from Alabama, so what do I know? But
Disclaimer there, but
I think our track record speaks for itself.
No doubt.
And like I said, to summarize, we're right in the throes of the street fight economy. You got to punch your competitor in the mouth and drag their customers back to your business to start taking care of them. And it's a different game. And when you're still trying to run the plays, of the past, you might have some marginal success, but your stronger competitors are going to run past you and put tire tracks up your backside.
Yep.
And so and there's no time like now to start. And we got to get going. But my little ray of Mr. Sunshine is if you're one of the best competitors, show it and you're going to do fine. But if you've got weaknesses in your business, you cannot let the sun go down on getting active about doing the hard things, getting profitable what you got, retain cash to get to your full capitalization point. And if you're fully capitalized and profitable, you can take some body blows and still be in the game. But if you're highly leveraged, if you're not profitable what you got, you're on the clock.
Yep.
And you're about to run out of the shot clock, and you got to take a shot and make it work.
Words of wisdom right there.
No doubt. So register for the summit, simplenumbersummit.com. You'll hear more from Greg there, obviously, and probably before then on the podcast as well. And, like Greg said, there's some businesses out there that you're going to see some challenges in. Give us a call. We are more than happy to chat with you. We'll chat with you for a little while just to get a feel and give you some ideas and guidance around where you're at. Just mention that you listen to the podcast and you're interested in chatting with us for a little bit. We'll give you a general idea. And then, you make a call as to, hey, are these folks that I need in my corner coaching me up? So reach out.
Yeah, great. Well, everyone, thanks for joining us. For Brandon, Greg, I'm Mike, and we will catch you next episode.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.